What's going on? Welcome back. Ryan here. In this video, we're talking about the long call and long put, otherwise known as a substitute purchase or a substitute sale. And we are going to look at this strategy in depth, and we're going to see just how powerful just buying options can be. Okay, so let's jump into a chart. I'll bring up gold futures. I want to talk about gold first. So what I've done here is on this chart, this is a daily chart, right, where I have these Keltner channels, and this is one standard deviation, the green bands, and then the purple's 2 standard deviations, and the red is 3 standard deviations. We have the volume, we have this TTM squeeze and this TTM wave, and we also have this ATR. So when we think about buying calls, buying puts, right? The calls, remember, for purchasing, and the puts are for selling. Most of the time, when people make the most money on a trade, it's usually just buying options outright. And it's important to understand where you're going to lose money doing this. So what I want to talk about first is where you're going to lose money, right? So let's just take a look at this graph and just make an assumption, right? So this kind of looks like support here, right? So if we drew a little line right here, we could see that there's a little support there. And right now we can also see that these bands are starting to contract inwards. There's already a squeeze forming down here. Now, this wave, this TTM wave, kind of tells us the momentum of which way this squeeze could fire. So depending on which way this actually goes, right, whether it breaks down and starts to go down, or it then starts to rally back up, it's important to understand that what we're witnessing here is a market going from trading sideways here, right, where it was consolidating, okay, and now it's starting to squeeze and the volatility bands are starting to contract, meaning that there could be a potential directional move, right? So when you're trying to capture directional moves, remember, we have a lot of option strategies. And when we think about just buying calls, buying puts, right, long call, long put, when we think about gold here, and we think about this being the gold futures contract, right, this contract could provide us a way to take physical delivery of 100 troy ounces of gold. Okay, so for businesses in the world that use physical gold, this is a very important feature to have, which is the ability to have a substitute purchase or a substitute sale, which allows them to hedge their price risk, right? It also allows us as speculators to make money in these markets, right? So when we think about this long call and long put, right, if we thought this market was going to fire upwards and gold is going to go up, right, which there's a lot of inflation right now. So I would be willing to bet that gold is going to make new highs, right? So maybe gold could rally up here. This kind of looks like a cup and handle, right? Where you have this big cup here, and now this little part could just shoot all the way up. So let's say that we just wanted to use options, right? A long call, right? A bullish play to buy gold, right? With the anticipation that we might take delivery of that gold, right? So we could do that by coming in here, and again, we're the real trick to buying options is always buying more time than you think, right? Because remember this graph, this picture, right? If we're buying options and we're buying less time, right? So under 30 days, which would be these 4 expirations right here, there's just not that much time left, right? The options price is accelerating, it's decaying at an accelerating rate as it approaches expiration. So this is where most people lose money, right? Experienced traders always want to think about how much money you can lose, right? Because at the end of the day, your goal should be to grow your investments over time at a compound rate. And the way that you do that is by managing money correctly, having small monthly wins on a large amount of money that compounds over time. So when we think about buying options, right, we have to always have our plan, right? Any trade you do requires a trading plan. So again, looking at this, and just for the sake of example, looking at this price action, right? We see the squeeze is forming, and the histogram is moving back towards this 0 line, and there's been some consolidation, and price is actually trading around its average, right? This is really the safest place to buy any asset, is near its average or mean. So when we come in here, like if we wanted to buy 126 days out, and we can get all of these, right? So for instance, right, so remember, when we're buying options, we always want to err on the side of caution, so we always buy more time. But when you're trying to capture a directional move, the mistake that everybody makes and where you lose money is this. People come into these options that have no time value left, and they buy these options out of the money, right? Or they buy the ones at the money with only 2 days left, and then this thing just doesn't move, and then their money erodes away. As opposed to experienced investors will know that over time, you're better to come out here, and obviously the difference in price of this contract, right? $61.30 times 100 shares. So this is a $6,100 option, as opposed to looking at this 24-day option where it's about 1/3 the price, right? So $2,300. That's where people mess up, right? And this is why I can't stress enough, when you're trading options and you're building a portfolio, remember, until you have enough money to where you don't have to take that much risk and you can make these small gains on a large amount of money, you need to have a high-paying job, right? Something else, different side hustles and things that all contribute, until you get experienced enough to where you can just rely on your portfolio and your skills as an option trader to make money. But back to this example, right? So here we have gold. We think it's going to go up, right? Maybe we're seeing a cup and handle. Okay, here, right? There's a squeeze, whatever. And now we think it's going to go up. So how would we actually figure that out and protect capital and give us a good chance of making money? Well, if we're buying options here, obviously we're if we have this bullish view, I don't think January 24 days is enough time, right? I mean, we need to be like at least out here in this area to see what happens here. And we also need to be aware of price action in case this market does go down, right? We need to be aware of that and have our risk tolerance. But I would always err when you're buying options for a directional move. I would always err on buying more time, and not only buying more time, but understanding that when we're trying to capture a directional move, it's better to buy options that are in the money, right? So again, remember, people make the mistake of not buying enough time and buying these deep out of the money calls or puts, and the market just doesn't move, the time erodes away, and they lose money buying options. Instead, much better to buy more time, and for the directional move, we want to buy options that are in the money, preferably 70 deltas, right? So and this is the hard thing, right? People need to have the discipline to understand that sometimes you need to wait until you have enough capital and experience to trade some of these assets that require more money, right? Because this 126-day gold futures option, right, 70 delta in the money, this is a $10,500 option, right? And just important to realize that you don't need to, it's better to be disciplined and approach this the right way than just gamble, right? Because people who are buying short-term options out of the money are taking unnecessary risk that is not going to play out over time, right? And it takes people a while to learn this. And a lot of people have the false sense of security because maybe they've won like money doing this, right? You could see that if we look at something like GameStop, right? People who bought options, right, on GameStop and crushed it, right? Because this thing went parabolic and they recognized this opportunity. Sure, this was a great play, like all the people who bought some of these short options out of the money, dumping a lot of money. Sure, you can make a lot of money. But just remember, we want to understand that when we're buying options, it's much better to buy a little bit more time and a little bit more in the money if we're trying to capture directional moves with buying calls and buying puts. I know that this is going to help you because in your own journey of trading, I'm sure if you haven't done it already or you have done it, an important lesson is to like make a trade during earnings season on a stock, right? And you'll see that people they tend to buy these short-term options out of the money, again thinking that it's going to move, thinking that they're getting a good deal when in fact the market's not going to move that much, and the theta decay is going to eat up that premium, when instead we want to, and this ties into people trading too much, right? If you're trading too much, you're always trying to take these little trades with these short-term options, it really just opens up a whole area where you can lose, as opposed to being very disciplined, right? Having different income sources where you have lots of income coming in, and then the majority of it you're just stashing that cash away into interest-bearing assets that are compounding over time, and then you're selectively taking money to use as your options trading fund to supplement and to accelerate the growth of your portfolio, at the same time protecting it by using option strategies for hedging and different things that we're going to see. But again, I think that people don't realize how lucrative and profitable just buying options can be when it's done the right way, right? And when you're buying options outright, like calls and puts, right, where you're doing a substitute purchase where you buy the call, or you're doing a substitute sell where you buy the put, very important to understand where you're going to lose money, right? Which is why I'm putting so much time into telling you that, telling you this, right? That you're going to lose money buying these options when you buy less time out of the money options like this, right? Right? Like, look at the theta on these, right? These are losing these are losing tons of value, right, with these last 2 days, because it's accelerating. As opposed to when we look at like this 24-day option, right? Sure, the theta is still losing, but it's a lot less. And there's a lot more time value here for you to capture a directional move. Okay, so again, I know that I'm kind of talking about a lot of things, right? But I just want you to understand where you're going to lose, because this is more important than how much money you're going to make, right? Because if you keep doing this, you're going to see how much money you're going to make when things go right, and it's going to be great. But it's more important to understand where you're going to lose, so that we can train ourselves to not make these mistakes. And when you're purchasing options, calls or puts, right, that mistake is always going to be not buying enough time and buying options too far away from the money. So let's actually take a look here. So if we think gold's going to go up, let's come out here to this 126-day option, and let's just buy this delta 70 right here. So we'll put that order in, and we'll just buy one of them, and we'll go in the middle of the bid-ask spread, and we'll just analyze this trade, right? So we just right click, remember, and then we analyze the trade, and here it'll bring up, we go to this risk profile. So we actually put 2 in, so it's 2-1, and now we can see our trade here. So we can see that this is a $105 option, right? So $105 option, right, times 100 troy ounces on this gold contract gives us this price of $10,500, right? So the maximum that you could lose buying this call option is that premium, right? $10,500. And we can see that this purple line is our time value right now. So, and we can see that this 1825 is our break even. And what's interesting here is our date, the 22nd, right? So we'll actually go like this. And what's really amazing about this software is we can see how time and volatility can change what this can do, right? So if we actually step through this and I go forward with this date here, we can see that the value is approaching this blue line, right? The blue line is the intrinsic value at expiration, and here is our time value. And as time goes forward, the option erodes away until there's no more time, right? So now this position, if it didn't move, would be down, and we can see that in this bottom left corner here exactly what the option price would be, right? So if we go back to today, right, which is 12/21, we can see that if gold accelerated, you know, and went to 1850, right, we could see that we could cash this option out at 42.52 if it did that right tomorrow. I'm sure volatility would go up. These numbers would change, right? Because volatility can change the risk profile of these trades as we're making them. But again, important to understand, right, that we can come in here and that we can look at what this looks like, this long call graph, right? So most important part is being able to look at this and understand that, right, when you're buying a call, this is the graph of what this risk profile looks like, where we have limited risk, right, where we can only lose the option paid, the option premium paid, and that this is a bullish trade, right, where we make money when the underlying asset goes up, right? And we're going to quickly look at the put on this, right? So here's our call, and let's come back into this gold futures, right? And maybe we think gold futures are going to go down. So again, we could come in here and we'll buy this 70 delta put option that's in the money, right? And I'll click analyze trade, and now again we'll just make it one contract, and what we'll do is we'll take off that call, right? So here is what the put looks like. So again, remember this put maximum we could lose, right, is the $126.10, right, times that 100 troy ounces, which gives us 12,610, right? So that's the maximum you would lose if the market continued to go up and it didn't go down, right? So important to know, right, that when we're looking at the long call and the long put, right, buying a call or buying a put, right, when we're buying that call, we're buying the right but not the obligation to purchase this underlying asset at a given price before a certain date. When we're buying that put, we're buying the right to sell that underlying asset at a given price before a given date, right? So this put makes money when the market goes down because we're selling here, right? The strike price is $18.90. It's a put. We paid 126 points, 10 cents, right, times 100 shares. And we can see that if it goes down, we would be making money here. So important to play with these things, right? Look at this stuff yourself. Buy calls, buy puts, analyze trades, right? So again, this is the call. Here's what the call looks like. And here's what the put looks like, right? They're mirror images of each other, right? And obviously they're going to differ because their prices are different and their strike prices are different, and option prices can vary between contracts, like in the sense that the parity of the calls and the puts might be different, right? Volatility might be skewing to where the market is anticipating a higher probability of a downward move versus an upward move, or vice versa, right? Maybe the market's pricing in a skewed volatility for the market moving up versus down, right? And then the option prices might reflect that, as they might be more expensive or cheaper, whatever it might be. But again, the idea here is to understand this software, understand that we can come in here and look at assets and make assumptions, and then we can look at these option contracts and we can analyze them, right? So again, the calls and the puts, I just want to reinforce this, and that is, you're gonna lose money if you buy these short-term options out of the money, right, with little to no time value. Uh, Now, obviously, nothing's guaranteed, right? Uh, Anything can happen, right? The market could rally, you could still make money. I'm not saying that. I'm just saying that it's important to understand where you're going to lose. In the majority of time, when you're buying options, this is where you lose. So important to just know the risks, right? Important to, when you look at a strategy, when you're trying to figure out what it is that you want to do, that you understand, right, where you're going to lose and why that's going to happen. Okay. So again, when you're buying or selling options, sorry, when you're buying options, calls and puts, and you're trying to capture directional moves, it is much better to buy more time, trade a longer term trade, swing trade, and buy more time and buy closer to the money or in the money. Okay. And I hope this helps you. I know that it took me quite a long time to understand this, and it all goes back to what I said in the beginning of this video of really not understanding where I was losing, and it was because I was trying to save my money buying these cheaper options, out of the money when the market just doesn't move that much, or whatever may happen. You're just not giving yourself enough padding to really, make a lot of money the right way when you only buy these cheap little daily lottery tickets, right? It's like gambling. It's not uh, trading the right way. And it's not to say that there's not situations where buying or selling these isn't appropriate, right? If you just, and we're going to look at that when we look at the short call and the short put. But remember, there's a time and a place for everything. But when we're conceptually first starting, or we're trying to figure out where we're losing, it's really important that when we look at all these strategies, that we mainly focus on why we lose, right? And with buying calls and buying puts, that always happens again when we are buying options with little to no time value, and we're buying these out of the money options thinking that the market is going to make a huge move where we could capture this intrinsic value, and it just doesn't happen, right? And you no matter where you look, right? If you look at people trading or posting losses on Reddit, or if you've experienced this yourself, you're going to see that over time this is a huge thing. Okay? So I hope that this has given you some insights to buying calls and buying puts, right? Again, to recap, we want to stay away from options with little to no time value. We want to stay away from buying deep out of the money options, right, with no time value. If we're trying to capture directional moves, it's better to buy more time in the money. I would say 50 to 80 delta. That is a good place to capture directional moves. And remember, options are not just for making money for yourself, right? There's a lot of businesses and ways as a professional option trader that we can add value to other businesses that are trying to limit their risk. And we're going to talk about this in a later section, but we want to, again, build confidence, understand the tools that we have available to us, take our time, be disciplined, have a plan, and know that by doing this, we are going to increase our probability of making high quality decisions and trades consistently. Okay, so if you have any questions, reach out. Again, I love to hear from everyone. Let me know what you think. Let me know if you have any questions. If you're already trading or you're already buying calls or puts, let me know what has worked for you. Let me know what doesn't work for you. I'm even interested in hearing about your signals. If you guys are buying signals from trading groups or you're in discords, I would love to know how that's going, if it works for you, if it doesn't work. If tell me why it works, tell me why it doesn't work. But again, I love talking about options, right? I love talking about this. I love trying to help people and instill confidence, because options can change your life, right? They can give you so much authority and power over your finances when you understand how they work, when you understand the value that they offer, not just to yourself, but also when you know how to use them to hedge risk for businesses in the real world. And we're going to talk about this again in a later video, but I'm super thrilled you're here learning this and that you're taking the time to apply yourself. And please, if you have any questions, reach out. And I'll see you in the next video.